In this video we are going to talk about 10 dividend stocks for 2022. So before starting this video, please like this video and subscribe to this channel for our future updates. The stock market can be quite volatile in the near term. Stocks, on the other hand, clearly outperform other financial assets such as bonds and cash over the long run. In a low interest rate environment, this is especially true. It's difficult for government bonds and bank savings accounts to deliver acceptable returns or cover a person's retirement demands when interest rates are so low. As a result, investors are turning to dividend stocks to make up for the income shortfall. Conditions are rapidly shifting, with interest rates set to rise amid a surge in inflation. Some traditionally dependable dividend stocks are failing, while new leaders in industries like real estate have arisen. Number 10. Unilever plc, ticker UL. Unilever is a consumer goods multinational headquartered in the United Kingdom. Soap, vitamins, pet food, personal care, coffee, tea, cereal, and a variety of other products are among the company's offerings. From its collection of more than 400 brands, this premium dividend stock earns nearly $60 billion in revenue each year. Unilever has battled with a lack of organic growth and profit margin pressure in recent years. Activists, on the other hand, have taken a keen interest in the corporation and are attempting to shake things up. Meanwhile, Unilever's operating results could improve as price increases assist the corporation in responding to the current inflation wave. For the time being, shares are trading at roughly 20 times profits and provide a 3.8% dividend. Number 9. Clorox Company, CLX. Clorox is another consumer staples business with a high dividend yield that is currently on the decline. During the epidemic, the company saw a boost in sales as the demand for cleaning supplies skyrocketed. However, sales have plateaued since then. Meanwhile, Clorox has been hit by inflation, as it has had to pay more for raw materials, labor, and transportation. When you add it all together, Clorox's profits are currently substantially below pre-pandemic levels, and the stock price has declined precipitously in response. However, this blue-chip stock sentiment may be overly pessimistic. Clorox should be able to stabilize its earnings over the next year or two as pricing increases take effect. Meanwhile, once the company has moved past the epidemic phase of higher sales volume, earnings comparisons will be substantially better. For the time being, shares of Clorox offer a 3.1% dividend, which is extremely high for the company. Number 8. Citigroup Incorporated, C. Some market experts said it was too late to buy the main American banks in 2022. After all, banks have already made up for their epidemic losses, and the market has been pricing in rate increases for months. The trade may have appeared to be over, but some of the banks have fallen down significantly from their highs. Citigroup, for example, has dropped from $80 last summer to around $64 as of February 22, placing the company back into the value category. Both trailing and prospective earnings are valued at less than 8 times. Citigroup is also trading at just 0.7 times book value, which is an exceptional bargain for such a big global banking company. Because of the recent price drop, the dividend yield has risen to 3.2%. Making it one of the finest dividend companies to buy right now. Number 7. Prudential Financial Incorporated, PRU. Another industry benefiting from rising interest rates is insurance. Prudential Financial may finally be ready to break out after years of sluggish trade. One of the major beneficiaries of interest rate hikes should be the life insurance industry. Customers' policy premiums are invested in financial assets, which is how insurance firms gain money. Due to historically low interest rates, the bond side of that combination has produced disappointing returns in recent years. Bonds have generated less interest than a historical model would have predicted, reducing profitability. However, when interest rates rise, Prudential should be able to earn a more acceptable margin on its investments. At the moment, shares are trading at barely 0.7 times book value, as investors remain pessimistic about the future. Prudential shares can now be purchased at a 4.3% dividend yield and less than 9 times forward earnings. Number 6. First American Financial Corporation, FAF. First American Financial is the second largest title insurance firm in the United States. This is a necessary service that most homeowners in the United States must pay in order to obtain a mortgage. The fortunes of First American are inextricably linked to the housing market. With a slew of rate hikes on the road, investors are selling off a slew of housing-related businesses. However, in the instance of First American, this could be a mistake. The stock is currently priced at only 6 times trailing earnings. Even if future housing market activity declines sharply, the company still trades at barely 9 times expected earnings in 2022. Furthermore, the company's rising realty software and digital services division helps to compensate for any potential weaknesses in its core title insurance business. And, thanks to the recent stock price drop, shares are now yielding 3.1%. Number 5. VF Corporation, VFC. Vans, The North Face, and Timberland are all brands owned by VF Corporation, a clothing and footwear corporation. The company is also a dividend aristocrat, which means it has increased its dividend for over 25 years in a row. For a company in a cyclical and fast-moving market like clothes, that's rather outstanding. VF Corporation has been able to do so because it buys its brands on the cheap and then alters them once they are under its control. It bought Vans and The North Face, for example, for pennies on the dollar compared to what they're worth now. VF Corporation, like many other corporations, is currently dealing with inflation and its supply chain. However, this is reflected in the stock price, which has dropped more than 20% in the last 6 months. The stock's dividend yield has risen to 3.4% as a result of this. Number 4. Gilead Sciences Incorporated, Gilead. Gilead Sciences, a biotech behemoth, has had its stock drop 15% in the first quarter of 2022. With this dip, Gilead is on the verge of hitting its lowest share price since 2013. Investors in pharmaceutical stocks should keep an eye on Gilead stock, which is now trading at less than 10 times forward profits. Gilead's main problem is that sales of its main hepatitis C franchise have been dropping as much of the patient population has been cured of the condition. To compensate for the decreases, Gilead has created and purchased additional medications, but this has been a long-term process. Gilead has also been active in the COVID-19 pharmaceuticals field, and as a result, its stock has been sold off as traders' enthusiasm in that subject has waned recently. Analysts expect the company to resume profits growth in 2023, and in the meantime, the stock currently yields a healthy 4.8% dividend. Number 3. Suncor Energy Inc, SU. Dividend stocks in the energy sector are frequently a smart location to look for them. This is especially true now, when oil prices have risen to levels not seen since 2014. At the present, the continued geopolitical uncertainty in Eastern Europe is supporting the price of energy goods. Large, low-cost oil producers are a haven in this unstable market against this backdrop. Suncor is Canada's largest integrated energy firm, for example. The company's crown jewels are its low-cost oil sands projects, mostly in Alberta. These assets have a long lifespan and consequently provide stable and reliable energy supplies. Suncor has strengthened its balance sheet and increased its dividend as the price of oil has risen. The stock currently yields 4.6% and trades at less than 9 times anticipated earnings. Number 2. Ambev SA, ABEV. Ambev, a Brazilian brewing company, is a fun way to profit from the present commodities boom while still getting a nice 3.7% income. Ambev is a subsidiary of Anheuser-Busch InBev SA, the world's largest brewing company, Bud. Ambev is largely focused on the Brazilian and South American markets. As a result, it stands to gain from the region's economic growth. Brazil is a major producer of commodities such as oil, iron ore, beef, coffee, soybeans, and other high-priced items. This should result in tremendous economic growth in Brazil, providing people with more discretionary income to spend on beer. In addition, the World Cup is approaching, which should be a significant drinking event in key Ambev markets like Brazil and Argentina. The stock currently trades at roughly 20 times forecast profits, and revenues increased nearly 30% last year as the company rebounded from the pandemic-related slump. Number 1. Cubesmart, Cube. Cubesmart, a self-storage company, is a clever method to profit from rising prices. During inflation, self-storage is a favorable asset class to hold. The majority of storage facilities are rented on a month-to-month basis, which allows operators to easily modify prices in response to changing market conditions. Furthermore, because these businesses often do not require a large number of employees, the impact of inflation on labor expenses is minimal. In general, because they extensively leverage their balance sheets to fund their property purchases, real estate investment trusts, or REITs, do well amid inflation. As inflation sets in, the value of these properties rises, but the debt burden decreases. In the current market, this is a win-win situation for Cube stock investors. Shares are currently yielding a solid 3.6%. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.